All right. I'm going to play a little bait and switch on you, not in that I'm not going to talk about Bitcoin, of course I am, but I'm going to use Bitcoin as an opportunity to talk about some more basic monetary and even macroeconomics. Perhaps it'll even be relevant for some of your work, but I didn't just want to talk about Bitcoin without providing some other background. So the topic of my talk is Bitcoin problems and prospects. And what I mean by that is simply a set of issues that Bitcoin raises, some of which point to some good possibilities, some of which point to some shortcomings of Bitcoin considered as a potential money. So as we go through this set of problems and prospects, I hope I'll be excused for going into some of the basic monetary economics that informs these issues. Now, I'm sure a lot of you would like to know some of the more technical details about the way Bitcoin works, and it is a very complicated technology. So for those of you who really want to know, just memorize this slide. You'll know everything you need. Okay, you ready? Got it? Great. Let's move on to the more important issues. It's the first thing I wanted to point out about Bitcoin that is a source of a lot of confusion is perhaps many of you have seen pictures of Bitcoins, little golden discs that look rather like the one in this picture. And that, of course, is a bit of a red herring. Those aren't Bitcoins at all. Those are actually rather fancy little Bitcoin storage devices or wallets that some clever person in Eastern Europe came up with as a kind of gag. But in fact, Bitcoin is a currency or money, sorry, I'm just getting used to this little wheel device, I don't usually use those, that exists mainly on computers and on storage devices, including those coins I just mentioned. It's a digital money. It consists of nothing but digits, right, ones and zeros, and it is transferred by basically interactions that take place over the internet or sometimes from other storage devices to the internet or to yet other storage devices. Let me just say what distinguishes Bitcoin most fundamentally from digital monies that have existed in the past. First of all, digital money is all around us in more conventional forms. What are the differences? Well, one big difference is that Bitcoin isn't dollar-based at all. It's its own currency. That is, other digital monies consists of digits that are representing certain quantities of dollars, whether in a bank account or in some other form of electronic money, and you can transfer these dollar values around just as you might do by writing a check, for example, except it's done electronically. And indeed, even most check transactions today are handled digitally without the paper itself moving around that much. So one difference between Bitcoin and other electronic or digital money is that it's a distinct currency unit. A Bitcoin is not a dollar. That's something that you can establish easily enough by watching the exchange rate between Bitcoin and the dollar fluctuate on a daily basis. Each Bitcoin today is worth something like $600. What's the latest quote that anyone's heard on Bitcoin? Anyone? Anyone look it up recently?
The current price is $377.
That's okay. Thank you very much for that. 377. It fluctuates every day. So Bitcoins are not dollars. On the other hand, another unique characteristic of Bitcoin is that, like paper dollars, they are person-to-person currency. Most digital money has to involve a bank at some point or some other financial institution. Bitcoins don't. In fact, banks have nothing to do with them. And you can use Bitcoins not just for transactions with firms or institutions to a limited degree, but also person to person. The only other important person-to-person media of exchange, much more important than Bitcoin, in fact, as we'll see, is paper currency. Right? Use US dollars. If you want to pay somebody for something right here on the spot, and that person doesn't have some elaborate app for the cell phone or something to use a credit card with, then the person-to-person medium you'll use is almost certainly Federal Reserve notes or some coins, etc. Well, Bitcoin is the only other such medium in existence. So that's another distinct feature of it. Finally, Bitcoin, because of the software, the open source software that allows you to engage in transfers and exchanges with it, contains an element of security and anonymity that is usually associated with cash, and yet has the convenience of the other anonymity that's associated with, say, digital dollars, that no one has to see you. So you can make a transaction with Bitcoin where, even though it's not actually a face-to-face transaction, still has the same anonymity as, or almost the same, I should say, anonymity as a digital transaction, in the sense that nobody can see you, plus the anonymity of there being no records of bank transactions or bank deposit movements, as there would if you were moving digital dollars around. So this is one of the features that has made Bitcoin somewhat attractive as an exchange media. Okay. Well, we come to the first, sorry about this, I'll get used to the wheel slowly. The first problem about Bitcoin is that even though it potentially could be money, and we'll talk about that potential in a moment, it's not money now. It is simply not. Why do I say that? Economists are pretty strict about what money is. We define money as a generally accepted medium of exchange. Admittedly, that's a pretty loosey-goosey expression. Nobody knows exactly when something becomes generally accepted as opposed to not being generally accepted. But it's fair to say that Bitcoin, so far, is not generally accepted. The vast majority of purchases that you can make right now, might want to make, you cannot make with Bitcoin. Most stores don't take Bitcoin. We know something's a generally accepted medium of exchange. You can walk into your average retail store and buy stuff with it without difficulty, right? And by that criterion, I think you'd all agree, Bitcoin isn't money. So that's the first fact. Dollars, of course, are money, whether digital or paper, as shown here. And they're overwhelmingly established money in the United States, at least, in fact, elsewhere as well. And that actually poses a problem for an upstart potential money like Bitcoin, because money is overwhelmingly what economists call a network good. Have you heard this expression, network good? A network good is a good where its usefulness depends on how many other people use it. A telephone's a good example of a network good. The first person who had a telephone didn't get much use out of it, right? But money is perhaps an even better example of a network good, because it being a medium of exchange, right? Its usefulness strictly depends on how many other people are willing to use it as such, and therefore accept it in trade for whatever they have to offer. So when you have a well-established money, a new money faces the problem of establishing a network when there's already an obvious network for everybody to join, right? Why would you bother holding something as a medium of exchange when you know everybody is already accepting something else as a medium of exchange? Why not just stick to the network that's already so well established? I want to pursue this point a little bit further by referring to the most important theory of how money gets established when you start out with no money at all, when you start out in a world which hasn't developed any money yet. That theory comes from the Austrian economist Karl Menger, whose picture is shown here. And the reason I want to talk about it for a moment is because that theory actually seems to suggest that something like Bitcoin could never become money. Could never become money. So how does Menger's theory work? to think about it, you have to imagine again that we're in a world where nobody has come up with the idea of a generally accepted medium of exchange, of something that we all are willing to trade for and trade with. Right? It's hard to conceive of that sort of situation. The closest that we can think of in modern times might be a POW camp, right? The prisoners are all rounded up, they're put in a camp, they've got goods they can trade with, like from Red Cross parcels, but their money, their conventional rest of the world monies have all been stripped from them, so they don't have any money to begin with. They've got to come up with something. That's as close as you get to a situation in modern times where money has to develop when it doesn't exist at all. Okay. Anyway, Menger's theory, which is meant to explain not only what might happen in a POW camp, but what happened in prehistoric times when the earliest monies developed, starts with people trying to barter, right? You trade the goods you've got for the goods you really want, if you can find somebody to barter with. But that's difficult because to do that, you've got to find somebody who wants the goods you have and has the goods you want. William Stanley Jevons called this the problem of a double coincidence of wants. That sort of thing is rare, right? So what do? Well, you might try to be clever and ask, what if I trade my goods not for the thing I most want, because I'm not able to find that person, but I'll trade for something that might be more popular, right? Even if I don't want it, so I only need one coincidence if I'm doing that. But then this more popular thing might be a good gamble for trading yet again to the person who has what I want. So imagine people experimenting with this kind of indirect exchange. Well, Menger's theory says that if people start experimenting that way, a kind of horse race will develop with different people at first trying different goods. But as people see some goods being more widely used, that makes those goods a better bet for them to try because they're becoming more widely accepted as a result of other people experimenting with trading for them to try to trade again with. Do you see what I mean? So a snowballing process can get going. To mix metaphors, it's a horse race that snowballs out of barter. You get these different goods jostling for popularity as different people try them out. But to continue with the horse race metaphor, if traders see one good being more and more widely accepted in exchange or used experimentally for that purpose, that's going to itself be a reason for them to say, hey, I think I'll try that too. And that's why you get a kind of bandwagon effect that results in eventually everybody wanting to use the same goods. Okay. I said earlier that this theory suggests that Bitcoin can't become money. Now, it actually suggests that for two reasons. First, something I've already pointed to. Once some money has become generally accepted, like the dollar is today, then why would anyone want to experiment with something new? There's already an obvious winner to the horse race, right? You just get on that horse. Oops, I went ahead to cowrie shells. I don't know why. Okay, well. But there's another problem as well. And that is that in Menger's theory, right, and that's a theory that assumes you haven't gotten established money to begin with, so it's not obvious what everybody should use. According to that theory, everybody's going to try to experiment with goods that they think are already pretty popular because people want them for other reasons, not as money, but because they just value them, right? So in that theory, things only get into the horse race if they're popular as non-monies to begin with, maybe as jewelry or as ornament or for some ritual purposes, something. We can see, for example, how in parts of the Indian Ocean, these cowrie shells became widely used once as money. Why was that? Well, they were popular as jewelry, as ornament. People wore them around their necks or as bracelets, that sort of thing. But what about these? Who wants them? I mean, how popular was the first Bitcoin before anyone was using it in exchange? What kind of person would have said, oh, I think I'll try to go grocery shopping with this stuff? Not only is there the problem that everybody knows you can use dollars, so why don't you just do that? There's also the problem that no one wants these Bitcoins, at least no one did initially. What for? There was no pre-established demand for them like there was for cowrie shells once upon a time, or for gold and silver as ornaments and other purposes. So it looks like really bad news. Bitcoin not only isn't money by the standard definition of the term, but according to the most widely received theory of how money evolves, it shouldn't be possible for it to become money. And that's, again, the first problem with Bitcoin. Now we come, though, to a prospect. And that prospect is that despite everything I've just said, Bitcoins might actually become money. Even though I just explained to you why, according to some pretty, I think, reasonable theories, right, shouldn't be possible. And yet, now I'm going to tell you that they might yet become money. Why is this? Well, the basic thing is that we've been surprised by Bitcoin. It contradicts our theory, not because it's actually become money, but because it's made progress in that direction that the theory said it shouldn't have even made. It shouldn't have gotten as far as it's gotten. In fact, as we'll see, but as many of you I suspect already know, you can go and buy things with these digits that aren't dollars, that aren't obviously useful as money, that don't have any non-monetary purpose that's easy to figure out, so no one wants them for anything else, yet there you have it. People are trading with this stuff. How did this happen? Here I have to go into a little history of how Bitcoin got started and how it has taught us that we have to interpret Menger's theory differently than we used to, a little bit more generously than we used to. Bitcoin started out, as far as anyone can tell, and putting aside the pseudonymous Japanese inventor of the thing, who presumably is somebody or some group of people. The fact is, though, that some computer nerds were playing around with this stuff. They were playing essentially a game, analogous to if a bunch of us were playing Monopoly, right, or some other board game, except we invented new fake money or new play money just for that purpose. But in this case, the play money that was being toyed with, right, had these features, though nobody at the time was thinking of them that way, these features of anonymity and security, etc., that actually distinguished this stuff that was just play money at first from any other sort of money, making it capable, giving it characteristics that actually no other money possessed that were desirable in themselves, right? Well, before you knew it, from being something that just a few people were playing with, and they were playing the Bitcoin game consisting of mining Bitcoins, as it's called, which is where you solve a problem, right? The so-called, you solve a mathematical problem and you win some of this play money. Okay, that's how it's done. It's a challenge, required, a certain amount of a clever use of computer power, back then relatively little compared to what's required to create Bitcoin today, and so on. So that's all they're doing. They're playing, let's see who can mine more Bitcoin. Eventually, though, some people outside of the original network of players discovered that they could put this play money to certain uses for which there were no other good substitutes, particularly given the features of security, anonymity that I mentioned before. Anonymity, not in the sense that it's more untraceable than good old cash. It's more traceable, in fact, but it's not easily traceable. The other thing, though, that's anonymous, that isn't anonymous about cash, is no one sees you when you make the trade. You see what I mean? So when you put those two kinds of anonymity together, the anonymity of untraceability and or relative untraceability, plus the anonymity of not being able to see who you're trading with, you have something attractive for certain kinds of exchange. And as everybody knows, a lot of the initial non-play use of this stuff ended up being for purchases of drugs and things, particularly on the Silk Road side that was subsequently shut down. But then it spread. And before you knew it, you had even a few major companies, Overstock.com being the major one, jumping on the Bitcoin bandwagon for whatever reasons, even though it was still a tiny bandwagon, of course, compared to the dollar bandwagon. And now we've seen a continued growth, and this makes sense too in the following way. Although the Bitcoin bandwagon seems like it's one that should have had an awfully hard time to getting started, to say the least, it is nevertheless true that the more people who climbed on it, the more tempting it was for others. So there is a tendency, once a new money gets off the ground, for it to have an easier time growing, and that gets easier and easier. There's an exponential growth. And in fact, if you look at there are not some numbers available about the merchants accepting Bitcoin, there has been exponential growth. A couple years ago, I lectured on this topic. They knew about 1,000 US merchants accepting it. A year after that, it was close to 10,000. Now it's closer to 70 or 80,000, and it's just climbing like this. So what does this teach us about Menger and all that? Well, it teaches us that we have to broaden our notion of what makes something popular or useful. We thought that meant that you had to be able to wear it, or like the look of it, or eat it, or something, right? Now we know that it might just be that there's a popular use for it consisting of wanting to play with it. So it's very hard to draw a line between something being intrinsically useful, as the language used to go, and it not being useful. Usefulness, like value itself, it's in the eyes of the beholders, right? If you were a nerd playing the Bitcoin game, you thought this stuff was really cool, and you wanted some. That was enough. Okay, next problem. If Bitcoins do become money, or did become money, let's suppose that everyone decided we like these better than dollars. It's not likely, but just suppose. So the next thing you know, you're in a Bitcoin world, a Bitcoin economy, not a dollar economy. Well, the problem here is that now Bitcoin is money. Would it be a good money? Probably not. Why not? Well, here, one of the features that actually is very interesting about Bitcoin, and that I'll later suggest has some real merits, is also a problem. And that feature is that the way the Bitcoin protocol works, the mining protocol, is such as to provide for an absolutely deterministic or fixed supply of this stuff. Not fixed in the sense of constant, but a fixed supply schedule. We know in advance exactly how many Bitcoins are going to exist at any given time. And that number is declining. What we have is a growth rate of the Bitcoin stock that is declining until it will level off eventually at about 21 million coins. It'll never quite hit 21 million, but it'll approach asymptotically this limit of 21 million Bitcoin. We're now, I think, about halfway there, something like that. No, a little more than that, about 2/3. Okay, so now one piece of evidence of why this is a problem, though I don't think it's a good piece of evidence, is if you look at the value of Bitcoin, of course, it's fluctuated wildly. This is a chart that's a little bit out of date, but you get the general idea. It's actually settled down compared to years past. But, of course, when you have a fixed supply of something and the demand can vary a lot, well, the result is the value will vary a lot. Now, it's a little unfair to judge Bitcoin's value stability, right, by recent experience, because so far the market for it is very limited. If it were really money, if it were widely demanded, that would stabilize demand somewhat. Even so, though, having a money with an absolutely fixed supply of, say, of 21 million units, which is what it will eventually be, is not the best basis for having a money of reasonably stable demand over time. Indeed, it's a recipe almost certainly for money that has deflationary properties. That is, prices expressed in Bitcoin units are almost certainly going to fall. I don't think it's bad if they fall gradually enough, but there's no reason here to be so confident that that's even going to be the case. With an absolutely rigid supply of money, they could fall rather dramatically under certain circumstances where the demand went up. Here's, by the way, this is a schedule of the, you have to excuse me for being very bad at this rotor thing. Come back. There it is. This is the actual supply schedule that I was describing before, so you get some idea of what it looks like. There we are at about somewhere around 13 million. The way the protocol works is it adjusts the difficulty parameter, which is how hard it is to solve the math problem that gives you a Bitcoin reward, right? How much computer power it takes. That adjusts automatically so that no matter how much computer power people throw at this thing, what the outcome is just as many total new Bitcoins as was originally planned. Okay, and that's what this chart shows, how that difficulty parameter evolves over time to keep the supply on schedule. Okay, so at any rate, we're going to end up with just 21 million or just under 21 million coins by around 2029. Even the gold standard, in comparison, was a standard where you always had fresh gold output. The supply of gold never stopped growing. In fact, it grew pretty rapidly in the 19th century. And so, although it didn't grow rapidly enough even then to prevent some deflation, the deflation was perfectly tolerable most of the time. Yet, many economists today will tell you that the elasticity of supply of gold, or its tendency to grow in order to make the value not rise too rapidly, was inadequate. Well, if that's true, then Bitcoin, of course, has a much greater problem because its supply will become absolutely, well, it is, in fact, now inelastic, no responsiveness. There's no tendency for more Bitcoin to be produced if the value gets really high. With gold, there was such a tendency because if the value got high enough, gold mining became more profitable, and more of it would take place. So we have to worry that a Bitcoin economy would perhaps face more occasions of depression, deflation, crises, that sort of thing, than even our gold-based economy did, or our modern economy for that matter. Now, it's a little bit unfair to have given you a picture of the Great Depression there, because to be honest, the deflation that took place then wasn't the gold standard's fault completely, certainly. It was because our banking system failed. Perhaps if we have a sound banking system with Bitcoin, we wouldn't have an episode like that. Nevertheless, the risk of a deflationary crisis would presumably be somewhat high, considerable. Prospect. How are we doing here? That's good, about halfway. In principle, right, here's some good news. You could use the same basic technology that's behind Bitcoin to make a money that's not only not inferior to the gold standard or to the present dollar standard, but far superior to either of them. That's what excites me about Bitcoin. It's not Bitcoin itself. It's the technology and the prospects for other kinds of cyber monies that are improvements upon Bitcoin itself, but are based on this same novel technology that it relies on. So that's what I wanted to talk about a little bit next. As background, though, let's remind ourselves that all present and past monies so far have had serious inherent shortcomings. Let's talk about modern money first, our modern Federal Reserve dollars. That's an example of fiat money. It's made of, it consists of something that has no intrinsic usefulness, to go back to that notion, which I know is a little bit misleading, but let's just stick to it for now. Unlike cowrie shells and gold, you can't do anything with fiat dollars other than use them as medium of exchange. Oh, now, some of you are thinking, wait a minute, I thought that kind of money shouldn't be able to develop, so now we have two instances where it did. Not quite. The way we got modern fiat currencies is that they started by being claims to gold, right? Once upon a time, not that long ago actually, if you had a Federal Reserve dollar, it was an IOU to gold. So its value rested on the underlying value of the gold, and the gold could evolve the way Menger said. But then the Fed, and eventually all central banks, decided to suspend the redeemability of dollars into gold. And when they did that permanently, they became fiat money. And so we found ourselves using intrinsically useless money that way. It didn't evolve Mengerian fashion. It was a more complicated story. In any event, that's what we've got. That's what all countries have. What's wrong with that? Well, in a fiat money system, there's nothing natural governing the supply of fiat money. It's completely governed through deliberate decision makings like making by committees like the FOMC that's shown here. 13 times a year, usually, they get together and they decide what the stance of monetary policy is going to be, blah, blah, blah. The stuff isn't inherently scarce, and so the temptation that you have to worry about is that too much of it will be created. But it's also possible, as we know from recent experience, for central banks to err the other way and create too little, as they did in 2008, 2009. So the problem with the fiat money is simply that errors or mismanagement by authorities can lead to disastrous outcomes, mismanagement of the supply. The most notorious kind of mismanagement is, of course, mismanagement involving creating vast quantities of the stuff that, of course, lead to hyperinflation. This is a picture of Zaire's hyperinflation of not long ago, where there were notes denominated in millions, even billions of dollars, and they ultimately weren't, I mean, Zairean dollars, they were this is Zimbabwe, not Zaire. They were ultimately worthless. So, and then of course you have other instances. So with fiat money you have the problem that its managers can abuse it. On the other hand, go back to gold. Well, we know that gold is naturally scarce, so you're not going to have a hyperinflation with gold. But what you can have, of course, is sudden discoveries that lead to pronounced supply or price level shocks, or an inadequate supply leading to deflation. The whims of nature in this case can throw a wrench in the money supply works. So for these very different reasons, both fiat monies and commodity monies like gold, the only forms of money that have been known until now, and still really the only forms, have inherent shortcomings. What's fascinating about the Bitcoin technology is that using it, you could create a protocol that avoids all the problems that you have with both fiat and commodity monies, that automatically regulates the supply, not in the naive way that Bitcoin is regulated, where it just goes whoosh and that's it, but that regulates the supply so that the amount of the stuff produced is, shall we say, macroeconomically smart in some way. It automatically adjusts supply in a way that is stabilizing. What's an example of this? Now here, of course, economists will disagree about what the right recipe should be. But one example of a popular rule is illustrated by this chart. This chart shows domestic final sales. That's one measure of total spending in the economy. There are others like nominal GDP, GNP. And I'm using it because it illustrates how much difference, how a rule or a money supply process that obeys or follows a very simple rule could have helped a lot in avoiding or making less serious the recent crisis. As you can see from this chart, if we make a trend of total domestic spending, if we draw a trend based on the period from roughly 88 to the late 90s, that was a period that's been known as the Great Moderation, where most authorities agree that things were going pretty well, right? But if we extend that trend line beyond that, we see that the actual path of spending rose substantially above the trend and stayed up there and even worsened in the course of the early 2000s. That's the period, of course, of the subprime boom. Some macroeconomists believe that the excess money growth that was fueling excess spending during that time was one, not the only, but one important factor fueling that bubble. Let's just accept that for now for the sake of argument, right? And let's also recognize that when the financial crisis hit, the opposite thing happened to spending. Having been above trend, it collapsed way below it and stayed there for a good long time, despite the efforts eventually of the Federal Reserve to try to boost it again, and also in part because in the early part of the crisis they didn't even try. Okay, well, if you find this compelling, you might also find compelling the argument that if we'd only had a monetary system that would have automatically kept spending, actual spending, on a nice smooth trend, which is here equivalent to, I don't know, about 4% annual growth at constant rate, right? That maybe we would have had a subprime boom, maybe we would have had a bust, presumably we would have if we had a boom at all, but it would not have been as serious because there wouldn't have been as much excess money growth stoking it, and there wouldn't have been the collapse of spending making it that much worse. Okay, all of this is just an example. You could design a Bitcoin-like protocol that makes the money supply or the supply of the new cyber currency involved. It wouldn't be Bitcoin, obviously. It would be some new brand, new style. You could make it adapt automatically where the supply feeds back from what's happening to velocity of money, the other determinant of spending, so as to keep you on whatever trend you initially decide is ideal, right? And does that job better than central bankers can be trusted to do it. You see how they did a lousy job, in fact, right? Now, you might not like the idea of stabilizing total spending. You might like some other macroeconomic, think that some other pattern of money supply is best. You could design that too. You could design any one you think is ideal. One of the things this does, though, is you have it done with cyber currency. The thing about the cyber currency type protocols is nobody can mess with them. Once it's going, nobody can change it. Bitcoin is set to grow to 21 million. That will not change. But similarly, if you had a smart cyber currency set to keep the growth rate of spending at 4.5% a year, once the thing is going, nobody can change it. That's why I put Dr. Strangelove's picture here. It is, in a sense, a kind of doomsday machine, but only in the sense that it can't be tampered with once it's set going. Now, you might think that's a bad thing. It was in the case of Strangelove's plan, because it involved sending nuclear warheads to Russia or dropping nuclear bombs on it. But in this case, the idea is to allow everybody to be confident that you can always count on spending being stabilized. You don't have to worry about mistakes of central bankers or their whims or them resorting to hyperinflation because there's a financial budgetary problem, etc. Okay, we come to another problem. This is really not a problem for everybody, but it's a problem for a lot of people in the Bitcoin community, because Bitcoin people, for the most part, don't want the government involved in Bitcoin or any other cyber currency. They see as one of the attractions of Bitcoin the fact that it is a non-government-based currency. And I like that too, by the way, in principle. The problem here is that we want something that is perhaps better than Bitcoin. Okay, that's okay. We've got 1 million alternative cyber currencies being established, so people could try to create the kind of cyber currency that I or some other macroeconomists would like. But the problem is, let's suppose we had a bunch of competing cyber currencies, including some that are macroeconomically just the thing for stability, etc. We think they're macroeconomically just the thing because we know some economics and we're thinking about the macroeconomy. But does that mean that open competition among alternative cybercurrencies would favor those that are more macroeconomically sound and safe? That is, if people were choosing among different coins, there's Bitcoin here with that pattern of up to 21 million and then it levels off. There's some other currency that follows some other plan. There's a whole bunch with all these different built-in supply behaviors, right? The question is, if they were competing, would the most macroeconomically sophisticated one, the one that's best for the economy as a whole, for stability, et cetera, would it win? I'm a big fan of currency competition, and I think in some versions it might be a very good thing. But in this case, I really doubt that we can be confident that if we put all these currencies on a level playing field and let consumers choose what they like most, that the one with the best macroeconomic properties would win out. Why is that? Oh, this is just to illustrate that we need to treat them all alike for tax purposes, etc., let them compete. The problem is that, well, let me go back a slide. One theory, Hayek's theory, was that if you had competing currencies, people would choose the one with the most stable purchasing power, and the firms supplying that kind of currency would win out. That's an example of the view that competition would do the right thing, so to speak. I think Hayek was wrong. I think Hayek confused what he regarded as the best currency from a macroeconomist or just plain old economist point of view. He assumed that consumers would have the same incentive to pick what an economist would pick as the best. But think about this. Suppose you have a bunch of cybercurrencies you could hold in your wallet. And I need your help at this point, right? Suppose you had a bunch of cybercurrencies you could hold in your wallet, and they were all equally popular, so there's no reason to favor one over another on account of the bandwagon size. Got that? All right? Now, so the only difference between these currencies is not how easily you can use them to go shopping. They're all equally popular. But as long as you've got them on hand, they're going to be in your wallet at least for some period of time before you turn around and use them for shopping. Everybody follow? Now, I'm going to give you a choice. Let's just suppose, for the sake of argument, that Hayek was right and stable purchasing power is what you want. Now, I'm going to give you a choice between three options. One is the Hayek option. That money will be worth, when you spend it, it will have exactly the same purchasing power as when you acquired it in the first place. Okay? The second one will have less purchasing power. That is, prices denominated in it will tend to rise, are tending to go up over time. It's an inflationary one. The third will have increasing purchasing power. Prices denominated in it are tending to fall. Another way to put this is the first money neither appreciates nor depreciates, the second depreciates, the third appreciates. Okay, which one would you want?
The third.
Yeah. Now I'm going to give you an option. One appreciates really slowly, one appreciates really quickly. Which would you favor?
Quickly.
Yeah. Rate of return is an obvious thing for you to judge by. So you go for the highest rate of return, but that means, when we're talking about money, the most deflationary. So the most deflationary currency would seem to have an edge here, but macroeconomists would usually agree, I think, for the most part, that even if some deflation were a good thing, surely the most deflationary potential currency is not the one we want to see win. And yet I haven't seen an economist explain, neither Hayek or anyone else, why we shouldn't worry that that would be the outcome of open competition among alternative cybercurrencies with different supply schedules. Problem. Well, I don't want to leave on a negative note, so we turn, if I can figure out, this is my guy thinking about which currency he should choose. And he would do what you guys did. Turn to the last point, which is a prospect, sort of. It's not a prospect I'm terribly happy about. I wish the government wouldn't have to be involved in any of this, and there are other ways in which I think just keeping the government out would be best. Still, given the problem I've just summarized, I think it's only fair to acknowledge as a potential good possibility, or better one, that given enough support for the idea from the public, if enough of us said, hey, you know, we know there's a good cyber currency out there, it may not be Bitcoin, but there's something. And we think it would be better to have this set up, determine our money supply than rely on a bunch of central bankers who screw up all the time. Then that pressure could cause central banks themselves to be compelled to embrace this technology that we think would be a good one. And I know it sounds really far out if you're thinking about the Fed today, which is as far as any central bank could be from wanting to have its hands tied by some cyber currency algorithm. But to suggest to you it's not as far out as all that, consider that until recently, the Bank of Canada was actually experimenting with its own cyber currency. Admittedly, it was meant only to be a substitute for coins at that point. They finally abandoned the experiment. I'm not sure why. I suspect politics had much to do with it. Even more intriguing than that, anyone know what this slide represents? No? This is my Ecuador slide. Most of you think of Ecuador anyway. Those are what are they? Alpacas. In Ecuador, the government now has a serious scheme afloat. I couldn't show you a picture of the Ecuadorian central bank. Do you know why I couldn't show you a picture of the Ecuadorian central bank? They don't have one. They're a dollarized economy. Very good. So I didn't want to show you more dollars because I already had a slide of that. Ecuador, perhaps, cynics might tell you, because they don't like being dollarized and they're trying to get a toehold back into having government control of money. Anyway, there's a scheme afoot in Ecuador to set up a government-administered cyber currency system. So there's an example, it's the only other one I can think of, where you have a government taking the initiative to do something along Bitcoin-type lines as a positive monetary reform. Now, I don't know whether they're doing it for the right reasons or for wrong reasons. I don't know whether the kind of cyber currency they would implement if they did this would be a good one or a bad one. I have no idea about those things. But I do think it's important to recognize that the kind of monetary system we have is the kind of monetary system we're willing to put up with, and that with enough public support, if there were better technology out there that could solve our monetary problems better than the existing arrangements do, then in principle we could, through enough support for a movement in that direction, take advantage of that technology to give ourselves a more stable economy. By the way, also on the topic of how far out this is, even right now there's pending in Congress, of course what the new legislature will do with it remains to be seen, but it's probably more rather than less likely to support the legislation in question. There's pending a bill that would subject the Federal Reserve System to a more strict monetary rule, reducing their discretionary control of the money supply. Now, this bill I'm talking about isn't contemplating anything like this. It's contemplating a monetary rule that the Fed would recognize and would be obliged to follow, or if it didn't follow it, it would have to explain to Congress why not. Okay? Well, if we can move in that direction, and if we really do think such a rule exists, it would be an improvement. I don't see why it wouldn't logically make sense to implement it in a technologically robust way that would make it not subject to the whims of politicians or Federal Reserve bureaucrats. So it's just something to think about, and it's this sort of thing that to me as an economist makes Bitcoin a fantastic development, even if Bitcoin itself turns out to be a big flop, which is perfectly possible still. Well, it's been a great audience. Thank you for your patience. I hope you got some something out of it.